This is the current federal tax developments for April the 27th, 2026. Federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, coming here from Phoenix, Arizona. And we're going to kind of look at what went on this week. We got a lot of ground to cover. Going to range from major shifts in the taxation of cannabis to some rather complex corporate substance doctrines to take a look at cases and other things that come up this week. So, what's our roadmap for this session? Well, we're going to be covering 6 key developments this week. About the tax implications of the recent medical marijuana rescheduling that took place this week. Talk about substantiation requirements for COVID-19 leave credits, or more lack of substantiation in that case. A 10th Circuit decision on the economic substance doctrine. A tax court case on indebtedness and substantiation of that indebtedness. The 7th Circuit's ruling on loyalty reward programs and, in essence, the claim of right doctrine, including whether the claim of right doctrine is only a doctrine that determines if income is included, basically. The IRS can use it to force you to pick up income. Can you use it as defense against having to pick up income if you don't meet all the requirements? Interesting question, right? And then finally, we got a case dealing with valuation and penalty controversies in a state tax examination. Let's go directly to the first topic, which is a rather massive shift for any taxpayer dealing with clients in the cannabis space. Well, part of them at this point. So let's go ahead and go on to that one. So, our first major development is the final order from the Drug Enforcement Administration regarding the rescheduling of state licensed medical marijuana. Nice long title for this. If you look in the printed materials, you look at the manual, we're just going to call this the rescheduling order of April the 22nd, 2026. But it goes on for quite a run if you take a look at the actual text. Right. For tax professionals advising clients in the cannabis industry, or for individuals using cannabis as a treatment for medical conditions, this is a highly anticipated, and it could be a really big shift in the application of federal tax law in this area. Now, there are limitations on this. We're going to talk about those too. This is not a complete fix. In fact, what it is a partial implementation of the proposed regulations that were issued toward the end of the Biden administration, and which recently there was an executive order from President Trump asking the agencies to accelerate dealing with that issue. They've gone halfway. So we got a halfway, and the other half is still scheduled to be addressed later. But we'll talk about where we're at in any event. So let's look at an overview, though, of this particular, document. Effective April 22nd of 2026, Drug Enforcement Administration issued a final order that transfers specific marijuana products from Schedule 1, the one that says, sorry, guys, under 280 Cap E, this is illegal trafficking, therefore you lose all your deductions, down to Schedule 3 of the Controlled Substances Act. Now, it's critical to understand the scope here. This reclassification applies only to FDA-approved products and products subject to a state-issued license for medical purposes. Right? It's limited. This is not opening up the entirety. And big thing, just right away, we're talking about your clients are involved in, let's say, a recreational marijuana selling operation. That's not impacted by this yet, right? They got to go to the next step before we're going to see anything there. So for them, nothing has changed. Nothing's deductible. But for those who are in medical marijuana, and that's especially important in states where only medical is the option, so everybody who is selling it legally is doing so under the medical purview. For the medical ones are now going to get a bigger break. It's an interesting question for states where you have both the medical and then recreational. How exactly we're going to make that work, and is this going to cause some people to go back and reapply to get medical only licenses? We'll have to see. But this bifurcates the federal tax treatment between state legal marijuana cannabis businesses and recreational adult use businesses, while it opens up new avenues for individuals for medical deductions, but you gotta meet criteria. This is important where we stand. So, historically, Internal Revenue Code Section 280 Cap B has been a punitive measure for all cannabis operations, strictly disallowing tradable deductions because marijuana was trafficked as a Schedule 1 or Schedule 2 substance. And basically, the only deduction you got was cost of sales. Because the DEA's orders moved state licensed medical marijuana Schedule 3, the text of the order formally acknowledges that the state medical licenses are no longer subject, or licensees, I should say, are no longer subject to the Section 280E deduction disallowance, so long as that is the entirety of their business. Now, be careful here. It gets messy if they're doing both medical and recreational. That gets into a whole mess, and there's a whole lot of case law there about whether you can sell other things, and generally it doesn't work well. Just going to say that. So be aware there. If you have the tainted stuff there, it's a problem. Now, interestingly, the DA administrator explicitly encourages the IRS to consider providing retrospective relief from 280 Cap B liability for prior taxable years, which is great. But it's like the IRS, encouraging DEA not to enforce certain drug laws. It's like that's not their agency's thing. Right? Not your area. Okay. So, tax practitioners, you got to exercise caution. The DOJ does include a standard disclaimer that this rule does not constitute termination of federal tax liability. In essence, you got to await IRS guidance before rushing to do things like trying to amend a client's past return. Now, that said, it gets into a really interesting area if a statute's about to run on a client's past return. Do you file a protective claim pending? That might be a smart thing to do, right? We'll see how quickly the IRS moves here, but if a statute's running, you might go ahead and do a protective claim saying, given, cite this notice, cite the DOL's, recommendation, and indicate, that this is protective, solely waiting to see if what if Treasury does on this issue. Right? If Treasury does not go along with retroactive, then, we don't have a claim. Right? We're not going to be doing the claim at that point. If they do, then yeah, we want to make sure it's on the record that we filed our claim timely. But right now, don't just do a flat out amended return. The IRS has discouraged those from day one when the first proposed regs came out for a proposed rule from the DEA. And they're still not going to be thrilled about it. But we'll have to see how long it takes us to get some sort of guidance from the IRS. Okay. Now we're going to take a look at impact on IRC Section 280E, right? The recreational facilities. Because while medical dispensaries see relief, it is crucial to understand the Schedule 3 reclassification is extremely narrow and explicitly excludes state legal adult use, or what's called recreational marijuana businesses. Because recreational cannabis is carved out of that order, it unequivocally remains a Schedule 1 controlled substance under Title 21 United States Code Section 812. Consequently, the deduction bar under Internal Revenue Code Section 280 Cap E remains fully in effect for business trafficking in adult use cannabis. Right? Other than medical, you're still on the barred list, right? Consequently, the deduction bar remains full in that full effect. These recreational businesses cannot claim standard 162 trader business deductions and are still restricted exclusively to calculating costs of goods sold. And remember, you do so without worrying about things like, basically 280 cap, in essence, cap A, right? So we're not worried about, this whole, 283 cap A, you get the right title in there. For unit cap and those things, you have a very limited cost of sales calculation. That's not changing for recreational. So make sure you don't overshoot on this. Understand it's very, 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 very much limited to those marijuana, people in the marijuana industry who are solely dealing with medical marijuana issues. They're dealing in other stuff. Yeah, it's still going to be a problem. So keep that in mind. Now let's go to individuals here. IRC Section 213 allows a deduction, itemized deductions for medical care, provided the drugs are legally procured and prescribed by a physician. Now, this same concept should apply to FSA accounts and HSA accounts, right? Although FSA accounts can be limited by the employer, so keep that in mind. And I think FSAs may be really fun to get to make payments under this. So just be aware. I wouldn't go submitting that bill right this instant. I would wait for a little clarity to come in that area. Previously, under Revenue Ruling 97-9, the IRS disallowed all marijuana deductions because its Schedule 1 status meant it was a federal violation, therefore could not be legally procured. However, under the new Schedule 3 classification, it grants medical marijuana a federally accepted medical use. That legal foundation of the revenue ruling is effectively mooted. So 97-9 no longer applies because a fundamental component that was used to justify its position is no longer there. It's gone, right? So that means that, taxpayers can now at least theoretically deduct these expenses on Schedule A. But you got to satisfy the formal prescription requirement of Section 213D3. Remember, it's not enough that the marijuana helps you, right? Because potentially aspirin helps you, right? Sometimes prescribed for blood thinning in some cases of some issues. So aspirin maybe helps you, or Tylenol helps you. But you still can't deduct them on Schedule A, right? Because they're not, unless they are prescribed. And yes, in theory, one can get Tylenol prescribed by a doctor, but it's really difficult to get a doctor to do that because it's going to take on liability if they do that. So essentially, it's rare that you'll see it, but it's got to be prescribed. So the number one rule is your clients who may now say, hey, I can deduct medical marijuana. I read it online. It's like, well, where's your, do you have a prescription? The IRS is going to ask to see the prescription. Did you get a prescription and fill that prescription for the marijuana? And again, I suspect a lot of people, especially in a state like Arizona, that has recreational cannabis, these people aren't getting their prescriptions necessarily, right? These days, they don't need it. So I would say you need to go through the formalities of getting the prescription together. That's going to be important. When we talk about, conversely, if a taxpayer purchases state legal recreational marijuana over the counter and then self-medicates, even under a doctor's orders, right? These costs are non-deductible. There are two reasons for this right now. First, adult use cannabis remains Schedule 1. Its purchase is an illegal treatment and fails the legally procured test under the still applicable Revenue Ruling 97-9. The fundamental underlying theory didn't change because you got it from a source that's not basically using it and going through the Schedule C status of the drug. We got a Schedule 1 drug here, and sorry, that's illegal. But furthermore, because it's acquired without a physician's prescription, I said, really interesting, it categorically fails the 213B requirements for a prescribed drug. So even if the DEA comes out next week and says, you know what, we also agree for the recreational use, we're going to open the doors on that too, it won't change this answer because that will not be a prescribed drug. So if your clients want to deduct medical use marijuana, they're going to need a prescription. That's clear, right, as we go through this. So now you got to carefully segregate in your clients medical and recreational cannabis activities. You're going to do that both for your business and individual clients. For the individuals, it's very simple. I need a prescription. I need and something it's treating that's considered to be, allowable medical treatment under 213, which is, treatment of the functioning of a part of the body, or dealing with reducing or dealing with the disease. But if you can show that, get the prescription, then these are going to be deductible medical expenses. Still subject to 7% of AGI limitation. Nothing's perfect, but they're going to be there. Now, finally, we've got as we have in these days, in recent weeks, we had our infographic here. So if you're not watching this, you're listening to the audio, you may want to go grab the slides from our website at currentfultaxdevelopments.com on the page for the audio and video weekly updates. And you should be able to find it for this week's, and you can actually then get this quick summary. Now, what this summary does is, we move from Schedule 1 to Schedule 3. It's limited, though, solely to FDA. Basically, FDA-approved products and state-licensed medical products. This is the limitation here. So those are the only ones that are now on the, hey, we're okay under 280 Cap E, right? We're good. Now, the major regulatory and tax impacts include relief from 280E deduction, prohibition for businesses, the opening of personal medical deductions for Schedule A for prescribed products that are on this list, and the ongoing requirements for manufacturers, distributors, and dispensaries to register with the DEA and pay annual fees. And that's on the bottom part of this. Didn't really cover this in detail or today, but it's in the order. You can check that order. You're going to discover that the fees you see there, $36.99 for manufacturers per year, $850 for distributors per year, and $88 for dispensaries. And as you can guess, numbers like that, they're inflation adjusted. Essentially, I'm going to presume those who will need to be paid and registered with DEA because it's still a controlled substance, but it has a medical use. And so that's the key difference here. So again, there's going to be a lot of things, a lot of hoops to go through, a lot of things that have to be taken care of to get in place for this. But there is a path now for medical marijuana and those who are in the medical marijuana industry to essentially become regular businesses and for your clients to get a deduction for getting prescribed medical marijuana, but we're still out in the cold for any other type. Keep that in mind. Okay, so that wraps up cannabis. Great. Let's move on to our second topic, which examines the strict substantiation and trade or business requirements that were necessary to claim COVID-19 leave credits. Remember those? Yeah, we had those. We'll be looking at the recent tax court summary opinion in Canada versus Commissioner. And this case highlights significant evidentiary hurdles self-employed individuals face when attempting to claim refundable sick and family leave credits under the FFCRA and ARPA. Remember those two bills? Especially when their documentation is lacking or highly inconsistent. The case is also really important, telling you that you can't just give different stories to different agencies or to different, for different individuals or at different times when benefits twitch. It looks like, oh man, I really could use this. So I'm not going to claim that I'm not disabled, unable to work. I'm going to claim I'm working, right? And I have all these earnings. Well, I didn't put them on the return, but yeah, you can see where we get in trouble. And that's basically this case. We're looking at Canada. So the factual background of the taxpayer, Marie Kanda. Between 2015 and 2023, she collected Social Security disability payments due to severe health conditions, and importantly for this case, never actually contracted COVID-19. She had medical issues, but she never got COVID-19. Keep that in mind, please. It's unimportant. Despite her doctor determining she was unable to work, she claimed to operate an auto mechanic cleaning business on the weekends for 2 to 3 hours a day. Now, anybody involved with Social Security disability knows that that may be problematical. That's why I'm a little concerned that she's telling different stories, different agencies. I wouldn't be terribly surprised if she gets a visit from Social Security following this case. We'll have to see. She failed to keep any contemporaneous business records, relying instead on her husband to maintain limited invoices and handwritten monthly expense reports that were internally inconsistent and never put in any sort of a formal ledger or books. Adding to the confusion, her tax reporting history for 2020 supplemental income was highly inconsistent. There were 3 different figures that ranged from $0 to over $80,000, depending upon which document you looked at. As you might guess, the higher number came when she's trying to claim the credits. Lower number came when she was just saying, no, I'm not working, or she's telling Social Security. Yeah, so we got a few different stories going on here in this case, and that's going to hurt her in the tax realm. Moving to her 2021 return, she filed a Schedule C claiming $10,190 in net business income from this auto cleaning activity. Attached to this, she claimed a massive $28,000 in refundable COVID-19 related leave credits under the acts. Unsurprisingly, the IRS audited the return. They showed no sufficiency, completely disallowing the Schedule C deductions and denying the COVID-19 credits. Now, they initially determined a tax efficiency at $26,560, while the penalty under Section 6676 for an erroneous claim for refund or credit, though the IRS did later concede that penalty. So we're looking at the assessment. Before applying the facts, the tax court reviewed the legal standard for claiming these benefits. First, under Internal Revenue Code Section 6001, taxpayers are statutorily required to maintain adequate records to substantiate their income deductions and credits. Second, under Section 162A, to have valid trade or business, a taxpayer must engage in activity with continuity, regularity, and a profit motive. That's the Grotzinger test from the Supreme Court. Finally, looking at those acts, the statutes that included these credits, right? Self-employed individuals must establish a valid need for leave equivalent to what an employee would require, such as facing a quarantine order or experiencing COVID-19 symptoms. These statutes also have distinct record-keeping requirements demanding proper documentation of the dates and reasons for the leave. As you might expect, this will prove challenging for Marie. When the court applied these standards, the taxpayer's case fell apart due to pervasive, per the court, evidentiary flaws all throughout them. The judge rules there was no legitimate trade or business because substantial inconsistencies cast doubt where the activity occurred at all. Was she just, I'm going to pay tax on 10 grand to get $28,000 worth of free money from the government? Probably that's not, that you get skeptical if you're a judge, I guess I'd phrase it. The court specifically notes the dates on our handwritten expense report suspiciously aligned perfectly with exactly the limited months that the COVID-19 credits were available. That's not suspicious at all. She only had income, right, in those months. That was the only activities were in that range. Otherwise, she didn't have any. And if you think this is just something people would do with things like this, anybody remember back in the real estate crisis in 2008? Your clients who had been flipping properties and claiming that they were capital assets and it's capital gains. And then suddenly when the market collapsed, they ended up taking a big loss on the last properties they were stuck with. Suddenly said they were in a trade or business, take ordinary loss. Yeah, this is exactly that sort of situation that we're doing this. She couldn't prove she had legitimate trade or business, the court ruled. Therefore, she failed the threshold eligibility requirements for the tax credits. On top of that, having never contracted COVID-19 or never faced a quarantine order, she completely established a statutory need for leave. In essence, nothing was there to back up this claim at the end of the day. There was just free money on the table. That's kind of how, as I remember during COVID, people viewing it that way. Why didn't you go get that money? It's like, I don't qualify for that money. But they'll never know. There's too many people applying. And yes, I heard that. And yes, I just, I never had to tell a client no, that, nope, we're not going to work with that application. But I did definitely hear it. And I heard it from multiple people, some of whom weren't clients, that made that statement. And unfortunately, it's way too normal. We see things like this, right? Now, the tax court ultimately delivered a very harsh assessment on her credibility. Pointing to the wildly conflicting self-employment income figures, the court stated that the inconsistencies suggested pure fabrication, per the court. The court sustained the tax deficiency of $26,560 in its entirety. The major takeaway here is that taxpayer general self-serving testimony will not survive tax court scrutiny without adequate contemporaneous, preferably independent documentation, right? Things from third parties, not just the taxpayer writing a note. You got to ensure self-employed clients are rightly substantiating both their baseline business operations and statutory requirements for any type of things like these credits that showed up for COVID-19. Remind clients that, if their story changed only when, and in her case, it was exactly when she was able to get a tax benefit from having a different story, that's not going to fly. And quite frankly, as a tax advisor, you should seriously, very seriously consider firing the client. If they want you to do that, just say no. Sorry. This doesn't pass the basic smirk test. I can't with a straight face say, unless you've got really good evidence about how you started right on that first date and how things ended right on the last date, and an explanation for why that happened, that's independent of I couldn't get COVID money, basically after that date, and I couldn't get it before, I probably have got to say, or whatever the next thing is that comes up like this. Keep that in mind, okay? Now, again, our infographic for this one, up on the screen if you're watching the video, and of course on the slides if you want to go download them if you're doing the audio. This is a summary why the tax court denied her credits, right? She failed on two major fronts. She failed to establish a legitimate trader business. You got to show this a trader business, right? You got to still meet the Grotzinger standards, right? And she failed the specific credit eligibility and substantiation requirements for this credit. You got to take a look at what you need to do. You can't just say, my friends are getting checks, I want a check. That's not good enough, right? Not quite the way it works. The chart highlights the stark inconsistencies in a reported 2020 self-employment income, jumping from 0 on her original return to over $80,000 on her credit refund claim. By original return, well, Social Security is going to see that, and that could put her disability at risk. But now there's this big, amount paid out, maybe more than she's getting for disability. So she's like, well, okay, I'm going to blow disability and do. I mean, it's tough to know, but this could easily whipsaw very quickly, where she loses her disability benefits and doesn't get the credit. We know she doesn't get the credit at the end of the day unless she, and this is a summary opinion, right? So she can't even appeal this. So we're done, right? Ultimately, her non-COVID health issues did not meet statutory need for leave, resulting in the court sustaining the full $26,560 tax deficiency. This reads like just looking for the check, right? And my friends got a check. That's not fair. I want a check. And, well, life's sometimes not fair. And that appears to be how this one came down. Okay. Let's move on to our third topic. This addresses the 10th Circuit's recent decision, Liberty Global versus United States. This is a warning for tax practitioners navigating international tax provisions as look at the reach of the codified economic substance doctrine over mechanical statutory compliance. And if you're not doing international stuff, and most of us probably aren't doing major amounts of that, this was a case that looked at whether was the statutory economic substance doctrine, if you otherwise followed the mechanical statute exactly right, does that mean that they can't apply that to you? And this was the argument of Liberty Global. And this is what we're going to be looking at this week. Right? Now, this is Liberty Global, which identified a structural loophole involving the enactment of the Tax Cuts and Jobs Act, known as a last day of year rule or mismatch. And if you actually read the case and follow the citations, look at the code sections looking at, we're not really going to cover those in detail here because that's outside the scope of what most people listening to this do. But we're going to understand that what they found was a way that essentially used the literal application of the statute to accomplish something that everyone agreed was not really the purpose of the statute. But they literally followed it, right? To exploit this, they executed a tightly integrated four-step transaction over just 4 days in December 2018, codenamed Project Soy. So we have a name for this, too. It was interesting. The first 3 steps manufactured $4.8 billion of artificial earnings and profits for a Belgian-controlled foreign corporation using springing to life debt. You can look this up and go in more detail. The artificial E&P was designed to let the company claim 100% dividend received deduction under Section 245 Cap 8 to offset a massive $2.4 billion gain on the sale of the CFC in the fourth step of the transaction. So essentially, we created effectively, right, a deduction that offset a big real gain. This deduction is due to the quirks in how the law was structured. That's where the problem is going to run in, at least Harris challenge. After initially complying with the temporary Treasury regulations that said you couldn't do that, the taxpayer filed an amended return claiming a full $2.4 billion deduction under Section 245 Cap A and sued for a $110 million refund. Interesting, Liberty Global fully conceded that the first 3 steps of the transaction served no substantial non-tax purpose and lacked economic substance, right? Instead, they aggressively argued that Section 7701A was simply not relevant because literal statutory compliance with the code overrides the common law doctrine. And 77010 is weird because it's a statutory provision that effectively tried to kind of just adopt by reference the common law economic substance doctrine that courts had been applying. Yeah, it's messy to write it up, so we're just going to kind of reference it. So there are weird structural issues with that section, but we've got it. They also tried to claim the states were categorically exempt because they utilized basic business transactions like entity selections. So there's this weird process, took only 4 days, but having gone through the 4-day process, we manufactured a big deduction. The 10th Circuit, though, firmly rejected Liberty Global's formalistic argument that literal compliance with the statute, ignoring 7701, right? Ignoring 7701O, literal compliance with the rest of the code blocks the economic substance doctrine of 77010 from being applied. The court looked at 770105A, which invalidates tax benefits for transactions that lack economic substance or business purpose. Relying on long-standing precedent, the court noted that transactions mechanically complying with little terms of the tax code can still be disregarded if they are merely tax avoidance scheme. The doctrine inherently remains relevant whenever a taxpayer seeks unintended tax benefits through economically purposeless transactions. In essence, remember, Liberty has conceded there was absolutely no purpose to these transactions aside from getting a tax benefit. There was no independent reason to do them aside from the tax benefit. And they're getting a tax benefit that even they effectively conceded wasn't really what Congress thought. Yeah, they're going for it. And as I say, the court said, well, Congress said use the old doctrine, even though, we're not going to write it up. So, the 10th Circuit appears to be okay, 10th Circuit appears to be okay with that here. Where they should be, different question, but they are. This raises some really weird concepts about, the proper use of the courts, etc. Can we go back and revisit that old doctrine, or does Congress, by doing this, effectively just validate those old rulings since they knew what they were and they accepted them? This is why this whole thing's messy. But right now, the key takeaway is, at least in the 10th Circuit, you cannot argue I mechanically complied with the law unless you're willing to go to the Supreme Court. Because the 10th Circuit has said flat out, we're not listening to that. We mechanically complied with the code. Right. In that thing, that's an absolute. When defining what exactly constitutes a transaction to be tested, the court relied on IRC section 770105D, which explicitly states a term includes a series of transactions. The 10th Circuit determined that Project Soy must be evaluated as a tightly integrated whole that took place over just 4 days. Consequently, the court explicitly rejected Liberty Global's attempt to categorize specific isolated steps as category exempt, basic business transactions. They're only being done to put together this big thing. You got to take the big picture. It's just noted that immunizing an entire tax avoidance scheme simply because it incorporates basic business steps would stymie the doctrine's purpose through, arid formalism was the term they used. I love that. By disregarding the artificial earnings and profits generated in the first 3 steps, the tax court rendered the massive $2.4 billion Section 245 Cap A deduction completely unallowable. It disappeared. So there goes $2.4 billion of deduction right out the door. Okay. Now, the primary takeaway here for those in tax is the mechanical utilization of the tax code will not guarantee tax benefits if the overarching transaction lacks a non-tax business purpose and economic substance. The court made it clear that taxpayers cannot escape Section 7701O by embedding standard basic business transactions within a larger, primarily and totally put together for tax avoidance scheme. Right, that structure. The ruling serves as a robust validation of the IRS's authority to collapse economically hollow, multi-step tax planning maneuvers, even if individual steps themselves are, just standard procedural steps. Ultimately, technical precision and literal compliance with the code are, per the 10th Circuit, insufficient without genuine economic substance. Now, the key question becomes, do other circuits agree with this view? And then ultimately, potentially, does the Supreme Court agree? We'll have to see. Right now, though, 10th Circuit, probably don't want to try this argument unless you are really, really willing to, push hard in litigation, or you're going to pay the tax and then go to the Court of Federal Claims. Yeah, to avoid the 10th Circuit. those would be your options. And I'm not sure going to the Court of Federal Claims is going to be helpful, but yeah, we know the 10th Circuit isn't. So we got that. Again, our infographic for this one presents a visual summary of the Liberty Global Project Soy ruling. It illustrates how the taxpayer attempted to shelter a $2.5 million gain by exploiting a last day of the year mismatch created by the Tax Cuts and Jobs Act. We'll say kind of accidentally created by it. A critical element highlighted here is the taxpayer's own fatal admission that the first 3 steps of the plan lacked both a meaningful change in economic position and a substantial non-tax purpose. Now, they admitted that because that's actually probably going to be a better argument for them. Realizing you're never going to win that argument, why make it and allow the court then to reverse on it? But the problem is it doesn't just mean go in there and say, hey, we got this, because the problem we found out through years of litigation that went on in the, remember, family-owned partnerships heyday? They still work, but you got to have a way bigger estate now for you to worry about them. But we had all these, was there an economic, was there basically a business reason for transactions? It became a big issue. And people would recite things and the courts just dismissed those recitations. They said clearly that's just boilerplate, right? And there's no evidence any of these are backed up. If you're going to tell me it's business purpose, it's not enough just say there's one. You got to have evidence there's one. Okay, please remember to back up statements with evidence. I've seen too many documents drafted that just simply recite there is business purpose, but there's no evidence anywhere in any file you can find that suggests what is it, right? Nobody has an idea what it is. Or they did, but then you take a look and the whole thing just falls apart like paper mache, right? Or let's say a wet newspaper actually falls apart like a wet newspaper, when you actually look at it in a detail. So, look at the evidence, make sure it's there. It's not just good enough to say you got it. You got to have it. Integrated transaction failed the two-pronged validity test of economic substance doctrine under Section 7701A. The court disregarded the manufactured earnings for tax purposes, which prevented Liberty Global from getting its $110 million. And I have a bad day sometimes. Our fourth topic now. This is a case of Catherine A. Simmons versus Commissioner, Tax Memorandum Decision 2026-34 on April the 22nd. Right. This case is a fantastic review of the recurring substantiation pitfalls that we frequently see with closely held entities, particularly regarding commingled funds, strict substantiation rules, and deductibility of interest on personal debts used for business purposes. Unlike our earlier case that we had on the COVID credits, this case doesn't really suggest that Catherine is actually wasn't really doing something. It's not there. It does suggest, though, you have really bad records, you're likely to get a really bad result in court, which is what happens to Catherine in this case. Now, in this case, Catherine co-owned a boutique partnership called Stuff LC with her sister. Because the partnership struggled to secure its own line of credit, the owners utilized personal credit cards and personal family loans to finance operations. This may sound familiar. Right? A critical problem arose because at least 6 of those credit cards were in the taxpayer's individual name only, with no reference at all to the partnership. The partnership then recorded the accrued interest on these personal cards as an entity interest expense and even wrote checks directly to the sisters to cover interest on the personal loans they obtained from family members. So, big issue. We got a lot of interest that's being run through this partnership. And the real question is it truly business interest? As you might guess, business interest requires the tracing rules. And bad records are going to be a real problem for tracing. Now, let's look at how the IRS and the court handled the partnership's expenses. The partnership claimed nearly $13,000 in automobile expenses. Now, because they are listed property, remember that, they're going to fall under the anti-Cohen rule, right? Which strict substantiation requirement section 274D. Therefore, the taxpayer must contemporaneously verify the amount, the time, the place, and the business purpose, right? The taxpayer only provided QuickBooks logs and lease agreements, which the court found was insufficient. Now, it's not that you couldn't have QuickBooks memo entries to cover this stuff, but it's really unlikely anybody's going to write up that long of a memo, right? And they didn't. Right? So without that, the problem with 274D is, And the court did exactly what the tax court does every time this comes up. If you cannot show the evidence to back up the deduction required by 274D, the deduction is zero because the code says it's zero. Right? Okay? The court noted a key reminder, why I call this the anti-Cohen rule. Right? The court indicated it cannot vote Cohen doctrine to extricate expenses that are subject to the strict substantiation requirements, 274D. 274D blocks Cohen. Now, hopefully everybody here knows what Cohen is, right? Cohen's the most cited case you're going to see in tax court cases. It is a case involving George M. Cohen, the vaudeville entertainer, Broadway producer, etc. He's got a statue in Times Square, which I always think it's really nice. They made a statue to the most important tax case. I was told by people in New York that's not why it's there, but we all know that taxes are truly the most important thing. So obviously George is there because George had his case and he won. So, we have a statue to George, so you can go see the statue. I've been at the statue of George, right? I've been to the statue of George because as a tax person, one must go to the statue of George M. Cohen. That's just required for all of this, right? At least U.S. tax person. We'll let you in other countries try to figure out who, what statues you're looking for, what your important cases are, right? Additionally, an $11,377 for deduction for non-reimbursed food was completely denied because the taxpayer lacked detailed evidence of the nature of the expenses, and it's also going to fall under Cohen for the years in question. So, yeah, watch out for the anti-Cohen rules. 274D. They're going to cover in years where you got an entertainment deduction. They covered that. Obviously, we're not getting those anymore. They also cover any of the meals. They cover any use of listed property, and that includes autos generally. Auto and travel in general. And this is our problem. They didn't have it. You need to keep contemporaneous records. A client asks, what should that be? I'll tell you, you want to know something that'll definitely survive exam? A log. There are apps you can get that will automate this for you on your phone because, the phone has GPS. As long as it knows when you start a trip, when you end a trip, you can tell it where you went. It could log those pretty easy. But you need something. And, you can't just say same as last year. Any client that answers you how many miles you drive for business this year is same as last year, you're saying none. So what you're telling me is you have no record. Under 274D, if you have no record, the law requires the deduction to be zero. Now do you want to reconsider your answer? I need records. And if I have reason to believe you don't have them, and I think I just now have that, I might need you to actually show them to me. But you need to keep records. Clients need to be told that you cannot say, the number one thing you cannot do is answer the question, what was our mileage? Same as last year. By the way, as an employer too, if you're basically providing cars to employees and they give you that answer, full value of the car goes in their W-2. Same issue. That answer says all personal use. 274D is your requirement here. You got to cover 274D. And if you don't properly cover 274D, look, the courts get zero. The courts don't cut this in half. They don't do that. They go zero. Because the law says it's got to be zero. When the law says it's got to be zero, the courts have no discretion. So keep that in mind. Now, the rules surrounding indebtedness proved to be a major hurdle for the taxpayer, not surprisingly. Under Section 163A, you deduct interest, but only if it arises from your own indebtedness, not the indebtedness of another party. You might guess that's going to be a problem here. The court denied the interest deduction on the family loans because there was no formal legal documents proving the partnership itself owed a debt to the owners. Unverified oral testimony is not enough. Remember, self-saving testimony of the taxpayers is not going to make it work. Right? Furthermore, because the credit cards maintain the taxpayer's name, she failed to prove the interest was partnership indebtedness. The court highlighted the owner's unsupported confidence that the credit card charges stemmed only from business activity is not sufficient to eliminate commingling concerns. So read carefully. This case does not say you could not use a personal credit card, right, solely for the business and claim that interest as a deduction. But what it is saying is you better have really, really, really good records, right? And absolutely prove for every single receipt, you can prove it has a business purpose, which is going to be difficult, right? Because the debt is yours and you need to have the partnership execute an agreement with you that they are going to pay you for that debt, legally binding one on the partnership, that they will do that. That was missing in this case. So now we threw out the auto expenses, we threw out the reimbursement of meals, and we're now going to throw out the interest. It's a bad day in court. Okay? Now, in essence, what we have here is, right, there's a technical issue, though, here that's kind of interesting. The intersection of partnership charitable contributions and ordinary business expenses. Under Internal Revenue Code Section 703A2C, partnerships are barred from deducting charitable contributions at the entity level, and rather they're passed out a separately stated deduction, right, you put on Schedule A. But in this case, the partnership hosted charity parties to drive sales and donated a portion of the proceeds. The court actually ruled in favor of the taxpayer here on conceptually. Again, their evidence is going to be a bit of a problem. But in conceptually, if you're doing this structure, so they would hold these, as I said, charity parties, and a portion of the sales from that party of the stuff they sold, they would give that to charity. That donation to charity was a marketing expense, right? Okay. Noting that leveraging as the court said, milk of human kindness encouraged customers to visit the store and buy things, qualified those payments as legitimate advertising expense under 162. Unfortunately for the taxpayers, you may guess where this is going, the actual deductions were still severely limited because the QuickBooks entries lacked necessary detail and failed to secure contemporaneous written acknowledgments from the charities. That as they were doing, didn't have evidence of it. They weren't going to let them get around the CWA rules, which are big for charities, by simply, having his marketing expense. They're going to say, well, you need at least that same level of support as far as we're concerned to get the marketing expense here, per the court. Okay, now let's take a look. She also had some rental properties that weren't part of the partnership, right? The court entirely disallowed her utility deductions. While ordinary necessary expenses per reduction of rental income are deductible under Section 212, or potentially 162 if the rental is a trade or business. I get into that whole long discussion. The underlying lease agreements here legally required the tenants to reimburse Ms. Simmons for the utilities. Because the tenants ultimately bore the financial burden, she could not claim the deduction. Furthermore, the IRS successfully asserted 10 or 20% aggravated penalty under 6662A for negligence due to her inadequate record keeping. That's kind of textbook negligence. While seeking penalty relief, she offered only a general unsupported statement. The court firmly held that merely conclusatory denial is insufficient to demonstrate reasonable cause and good faith to abate penalties. You have to have taken reasonable steps for a person of your background and your knowledge to properly compute your tax liability. And just saying I didn't mean to, or all those issues, that's not going to be acceptable by the court. That's simply just negligence. Negligence is not that you meant to, but it's that you potentially just didn't take any sort of reasonable steps to assure you'd get it right. Okay. Now, again, we've got our infographics again, the broken chain, right? Which is the records. You lose the records, we're kind of, in trouble. They kind of break, everything falls apart. It illustrates the business expense pitfalls that were discussed. QuickBooks logs alone fail strict substantiation requirements unless they are incredibly detailed, which these weren't, right? For these issues, personal credit cards do not compensate business indebtedness without some formal agreements, which they didn't have. And charitable donations cannot be deducted as advertising without proper receipts. The graphic also reiterates disallowance to reimburse utility expenses for rental properties. Ultimately, this whole thing reminds us of a fundamental rule in tax court. The IRS sufficient determination presumed correct. The burden of proof rests entirely on the taxpayer's records. You got to have those records. Failing that burden not only results in disallowed deductions, but also quite often triggers a 20% additional actually related penalty, coming back to the taxpayer, as it did in this case. Next up, we have got a case from the 7th Circuit Court of Appeals, Hyatt Hotels, Corporations, and Subsidiaries versus the IRS Commissioner. Right, this is case number 24-3239, and again, came out on April the 22nd. So, this case presents a fascinating look into the complex taxation of corporate customer loyalty programs. And more importantly for tax practitioners, offers a deep dive in the critical distinction between the claim of right doctrine and trust fund doctrine, as well as application of the trading stamp accounting method for estimating future redemption costs. And a really key issue here, which is an item of great interest, in this case, the Seventh Circuit specifically ruled that the claim of right doctrine that we generally in the IRS is generally considered to be something that is mainly used as a kind of a weapon by the IRS to force taxpayers to include income when they meet the claim of right test, can also be used by the taxpayer if you can show that you don't meet one of the tests involved in the claim of right to keep the item out of your income. And that's interesting and not a result I think the service is going to like, and a service that may have applications outside of this loyalty program situation that was what was involved in this case. So let's talk about the mechanics of Hyatt's program, known as a Gold Passport program, which is mandatory for all Hyatt properties, including the 75% to 80% owned by third-party franchisees. You all know, right? Most hotels are not owned by the chain. You go to a Hyatt, whatever, and there is the likelihood is overwhelming that Hyatt's not owned by Hyatt, right, in this case. To fund the rewards, third-party hotel owners are required to admit 4% of qualifying purchases into a central Gold Passport fund. Hyatt would then utilize these funds to compensate the hotel owners when guests redeemed points and to cover the program's administrative and advertising expenses. Since 1987, Hyatt had generally disregarded this fund for tax purposes. But eventually the IRS stepped in and said, wait, Hyatt, you should pay tax on that money, right? It said the receipts remitted to the fund constituted gross income for Hyatt, and the IRS argued Hyatt can only deduct the cost of these redeemed points in the actual year of redemption. Now, there's little question that we look at most actual redemption programs or reward programs that, quite often cases fall apart under this method. This one is a little different because it involves third parties, and that'll get there. Now, the Hyatt took this dispute to tax court with two primary arguments. First, argued that funds were not income under either the claim of right doctrine or the trust fund doctrine because the funds were legally restricted. Alternatively, they argued that if it was income, they should be permitted to use the trading stamp method of accounting on Treasury Regulation 1.451-4 to deduct estimated future redemptions up front. I kind of thought when reading this, I'm going to have to explain trading stamps to people. In essence, I'm old enough to remember S&H green stamps. And somebody tells they still exist, I'd be like, really? I don't know. I didn't check see if they do. But what you used to do is you used to go to because I remember as a kid, we went to the supermarket, and every time you went to the supermarket, you got these stamps. And these were S&H green stamps. And you put them in these little books. When you had enough of the books filled up, you could go to the S&H green stamp redemption stores. They had them around the country, right? And they had ones in here in Phoenix. And you would then turn in your books and you'd be able to get whatever, whatever thing they had that you could qualify for what you wanted, a toaster, whatever. Whatever they had, you saved up enough of them. And they had some really, really high-end things. We had tons of stamps that was realistically nobody could ever get, but always looked good. I could get a brand new car. Well, I had to buy a lot of groceries to get the brand new car, but hey, what the heck? As we went down that path. So that's the trade stamp method of accounting. We're going to talk about that. That's the industry they were talking about there, right? Okay. Now, the tax court ruled against Hyatt on both of these fronts. The court bypassed the claim of right doctrine entirely, stating, it has nothing to do with you being able to exclude items from your income, right? It's only an inclusion statute solely. You can only include things, but it can't take things that are being included and otherwise included and exclude them, so you can't use that, right? And it ruled that Hyatt possessed a sufficient beneficial economic interest in the fund, therefore failed the trust fund doctrine. The senior tax court barred the use of trading stamp method utilizing the claim, the cadum of whatever, ejusum. Got to watch it when they get into these Latin terms. I'll let an attorney tell us how to pronounce it. A generis to strictly interpret the regulatory phrase other property as basically meaning exclusively tangible property, therefore excluding intangible rewards like hotel stays and airline miles. right? That's basically how this one works, according to tax court. So Hyatt lost in this case. They had to pick up the income per the tax court. They appealed the case to Seventh Circuit. Seventh Circuit focused heavily on the interplay of the claim of right doctrine and trust fund doctrine, emphasizing the claim of right doctrine provides a basis for income exclusion that is independent from and broader than the trust fund doctrine. That's a concept we haven't really heard much of before. The court clarified that funds failing to qualify for an exclusion of trust fund doctrine might still be excludable under the claim of right doctrine. Using commercial loans as an example, the panel illustrates even if a taxpayer receives an economic benefit, the accompanying obligation can prevent them from asserting a claim of right over the funds. Ultimately, the appellate court ruled that the tax court committed reversible error by stopping its analysis merely because Hyatt failed the trust fund test. Right? They're saying, no, tax court, you got to go forward and analyze whether or not, they, in essence, the claim of right doctrine prevents them from having to pick this up. They lack a claim of right. Okay. Turning to the trading stamp method of accounting, Seventh Circuit corrected tax court's narrow interpretation of Treasury Regulation 1.451-4. The appellate panel observed that cash refers to money or its equivalent, meaning it can inherently be intangible. Because cash can be intangible, tangibility is not a required common denominator to the other property classification. Therefore, the lower court erred by using the canon to artificially limit other property to tangible goods, which improperly excluded these intangible rewards like hotel stays and airline miles. Can you get that? Will that be okay? Will those be there? And like I said, I'm certain if green stamps were still a big thing today, that, you would have had some way that you could transfer them for airline miles, because that became a thing after HH green stamps kind of went away. They went away because it cost money for the stores to participate. They had to pay. That's part of this trade stamp accounting. They had to pay S&H green stamps money for issuing their stamps, because that's how they got money when you went down to redeem. They had the money in place. And obviously, people decided they just prefer to pay less for groceries. And so stores that gave up the stamps were able to undercut stores that use them, because groceries, if you're not aware, is a very low margin business. So picking up those costs automatically meant you had to raise the other costs. You had to raise your prices to keep your margins the same. So, concluding the Hyatt analysis, the panel found the tax court failed to evaluate whether Hyatt held an absolute power to benefit itself over the Gold Passport Fund. It's a level of control reflective of the claim of right test. The Seventh Circuit vacated the decision and remanded the case for further analysis. They did not reverse. What they said was, well, because you didn't keep going long enough, you didn't analyze these issues, you're not done yet, tax court. You need to analyze this, right? The lower courts are instructed to explicitly determine whether the fund constituted Hyatt's income strictly under the claim of right doctrine. And furthermore, the appellate decision definitely strikes down the tangibility restriction for utilizing the trading stamp accounting method. They don't go further because appellate panels are not triers of fact. They're saying the court didn't go into and didn't hold hearings on the facts in these areas. We're not going to do it, right? Tax court, open it back up. You've got to hold hearings on this issue. Again, I'm going to tell you about the infographic that we have, and you can get with the download. It's a visual summary of the Seventh Circuit's reversal in the Hyatt case. It outlines two core issues: the determining taxable income and applying the trading stamp accounting method. On the income side, it illustrates the claim of right doctrine provides independent, broader basis for exclusion. That's probably the big takeaway for most of us here, right? Is that's an idea you might not have thought of, so keep that in mind. Bad news is it is Seventh Circuit, so you got to, outside the Seventh Circuit doesn't mean that your circuit's going to agree with that. I don't know if the Ninth Circuit panel would go along or not, but if you're in the Seventh Circuit, you can go. And a tax court must determine on remand if Hyatt's control over the fund was legally restricted. On the accounting side, it reinforced that loyalty programs are modern analogs to trading stamps, which they really are, right? Same basic concept. And validates that other properties in cash can be intangible, invalidating the lower court's tangibility requirement. By the way, kind of like green stamps, they also have a cost, right? That franchisee has got to recover the cost of sending 4% to Hyatt. And yes, they get paid when people use days, so some of that will come back. But also some of it that gets transferred to airline miles is never going to come back to hotel as additional revenue. So yeah, we're back to this. So yes, it is the modern trading stamp. That much I'll kind of agree with. Okay, next up, our sixth and final development today, we're looking at an interesting tax court decision, the case of Amplatz versus Commissioner. This is Tax Court decision 2020-635. Case dives into the high-stake world of state tax examinations, specifically focusing on extreme valuation discrepancies and a procedural battle over accuracy-related penalties. It's a great reminder for practitioners about the limits of procedural technicalities when fighting the IRS. The estate in this case is going to win, and it just generally isn't going to matter. We'll discover on the issues in question that were decided at this point. So let's go ahead and let's take a look at this case. Bax's case revolves around KA Medical, a medical device company formed by the decedent, initially funded with $19.5 million. Following Mr. Amplatz's death, the estate relied on independent appraisal to file Form 706. It valued its LLC units at zero and the promissory notes at $1 million as of the alternate valuation date. Right? However, just months later, it's always bad facts when it happens. It's good news, but bad facts for your estate tax evaluation. The estate turned around and sold those zero value LLC units for $15 million. Well, they found a buyer, which I understand that. Closely held companies, you don't find a buyer, it's not going to be worth a darn thing. And if they never found a buyer, it wouldn't be. But they got it sold for $15 million. As you might expect, the IRS noticed this massive discrepancy during an IRS audit. The examining agency subsequently adjusted the LLC's value to $15.1 million, which, hey, got rid of the income taxes on the sale, but it triggered a $5.6 million estate tax deficiency. That's not a good trade-off, not having to pay the capital gain on selling, because it would have been a long-term capital gain, right? 15 million, and exchanging that for estate tax. That's even with the net investment income tax issues. Estate taxes are, if you got a taxable estate, going to be going at a rate way higher than 23.8%. Even if you had a state in there, it's going to be difficult, right? Because the state tax is 40, is right, if I remember my numbers. Right? So, yeah, we're going to have trouble getting up to that level. Just saying. So, yeah, it's a bad trade. Now, to make matters worse for the estate, the IRS also assessed $2.4 million in accuracy-related penalties under 6062. Now we're hearing the estate's trying to whittle things and potentially get rid of the whole case by going after some procedural defects. And they attempted to strike down the penalties on procedural grounds, right? The IRS failed to comply with Section 6751B1. As a reminder, the statute mandates that the initial determination of penalty must be personally approved in writing by the examining agent's immediate supervisor. However, the IRS easily defeated this challenge by producing a civil penalty approval form signed by a supervisor roughly a month before the preliminary examination report was sent to the estate. The tax court ruled that because this approval was secured before formally communicating penalty decision to the taxpayer, the IRS absolutely met the procedural requirements. There's no way that this was too late, because the taxpayer had not been informed of a penalty. That's actually a point at which the IRS kind of committed to saying you owe us a penalty, and then communicate the penalty assessment, the proposed penalty assessment to the taxpayer until that point. So the court dismissed this. So that $2.4 million doesn't mean they're going to pay it, but it does mean it's an issue. They can't get rid of that issue from the case. So this is a loss for the taxpayer. Right? Doesn't mean they're going to pay $2.4 million, but it's a loss. They could have gotten rid of that issue entirely. They didn't. They carried this. Now, the next procedural challenge, looking at doing something a bit bigger, is compliance with IRC Section 7517. That section requires the IRS, upon written request, furnish a written statement explaining the basis on which evaluation is determined within 45 days after the request. After receiving preliminary examination report, the estate submitted a formal request under 7517. The IRS did not issue a direct response, but instead issued a notice of deficiency within that 45-day window. Now, so remember, the IRS never replied to 7517. The estate aggressively argued this lack of compliance should legally preclude the IRS from asserting its valuation. The court looked at the plain text of Section 7517, and here's the problem. The statute itself does not suggest to provide any enforcement mechanism or consequence for noncompliance. It's like, it's technically illegal, right? It's illegal, right? It's against the law, at least, well, per the tax law. You're penalized for not having adequate health insurance, right? You say, no, I was repealed. No, it wasn't repealed. The penalty is zero. So what they're saying here is this is the equivalent of the, basically, of the shared responsibility payment of zero. Congress put no penalty here. Without a penalty, there's no consequence. The court refused to just totally disallow the use of this valuation without the aspirations. Now, could that come back to haunt the service? Potentially. The court may, work on that. It could potentially, I guess, cause problems with their argument for negligence in some ways because they didn't explain how they got there. And so therefore it's not obviously negligent if you can't tell us how you got to here. It might be one of those things. They at least had something you didn't. So not sure, but again, there's nothing in the statute about compliance there, right? Because that statute lacked a built-in enforcement mechanism, the court bluntly refused the estate's request to invalidate the valuation. The court stated, without express terms setting forth otherwise, it's not going to graft extreme remedies onto a statute that Congress didn't mention. It's up to Congress to tell us the penalty. The tax court can't just go in, and penalize you for something if Congress didn't tell us what the penalty will be. It's illegal, but who cares? Right? It's illegal, but there's no penalty. Right? So we're not going to do that. Further, the court recognized judicial precedent holding even when a 7517 statement is properly provided, the information disclosed not binding commissioner. Ultimately, precluding the IRS from asserting a valuation is simply not a legally available remedy for a failure to respond to a 7517 request. Now, Congress probably should fix this. Note to Congress, fix this, but they haven't fixed it, right? Consequently, the tax court entirely denied the estate's motion for partial summary judgment on these procedural valuation grounds. Okay. Finally, kind of reasonable cause offenses 2.4 million actually have penalties. To avoid these penalties, the estate argued it acted with reasonable care and good faith under 6064C by relying on its independent appraisal. The IRS challenged this defense by pointing out critical facts or disputes, specifically questioning whether the estate had fully disclosed the concurrent, highly lucrative $15 million purchase negotiations to the appraiser near the valuation date. The court emphasizes that reasonable cause requires ordinary business care and prudence, inherently a fact-intensive inquiry. Because establishing reasonable cause requires a comprehensive review of all the facts and circumstances. Like, when did they know the $50 million negotiations were real, were going on? And did we ever tell the appraiser about those? Because it might have been a valid thing for them to know about, right? The court denied summary judgment for the penalty abatement. It'll be up to the IRS and it'll be up to the taxpayer and the IRS to deal with this, right? We get to trial. The taxpayer needs to show, and as I said, the IRS is going to be looking at, when did you know? When did you know? When did you tell the appraiser? What did you know? When did you know it? And when did you tell the appraiser? That's going to be the key question. And that's something they're not going to do on summary judgment. So our final infographic is a visual summary of these rulings on the procedural and penalty issues in the Amplatz case. The valuation stakes, the entire estate claiming a zero value for the LLC units compared to the IRS $15.1 million. Right? And again, the chart summarizes on the left the procedural compliance rulings. They successfully demonstrate valid supervisory approval for the penalties. So the penalties are in play for formally notifying the estate. Furthermore, it highlights the court's refusal to block IRS valuations, reiterating that while the IRS obviously failed to comply with 7517, they never told how they came up with this, right? The estate's attempt to use good faith reliance on basically, there's no penalty. Congress fouled up. Congress needs to fix the law. The courts will not fix it for them, right? Finally, as shown at the bottom right, the estate's attempt to use good faith reliance on appraisers is what cause offense is a fact-intensive issue the court has sent to full trial. Merely saying I got an appraiser, that's going to be better than not getting one. But if it turns out that the appraiser was not made aware of a very significant material fact, and that's the IRS's effective assertion, then may not have been so reasonable to rely on it. Or at the very least, if you knew there was a $15 million offer pending, right? And you knew it was, it was reasonably possible that it was going to go through. Yeah, filing your estate tax return and claiming a zero value might have been a little bit of a problem. Remember, because they took the alternate valuation date, which was 6 months, which means we're actually moving to later portion. Come up with this, and that also gets you in play in doing it. Okay, so this concludes the current federal tax developments update for April 27th. We've had a lot of interesting developments, I think, today. Things are a little bit different. Cannabis taxation, to substantiation requirements, and other complex battles that went on in these cases. I want to thank you all for watching this week. We will be back next week with May's first session. Hey, we're coming up with another due date, too, the not-for-profits. Remember, May 15th. For calendar year and not-for-profits, there's the May 15th date coming up. That's all to be fun. Again, I do monitor the Connect sites for Arizona, New Jersey, Idaho, Minnesota, Illinois, and Washington. So you have questions, you can post things there. I'll respond to some things if I think I might be able to help. And also, you can email me at the email address that you'll see in the slides and on the screen if you're watching the video right now, edzollers@currentfederaltaxdevelopments.com. And if I see your message, I'll try to get back to you. Otherwise, have a great rest of the week, and we will see you next week with more current federal tax developments.